Hey Bowtie Nation, Joseph Hogue with your weekly stock market update now Sundays at noon before the week starts with the stocks to watch and the stock market news you need to see. And Nation, everyone is waiting for the AI bubble to burst like it's 2000 all over again. Nvidia is up 1200% in 5 years. Micron technology has tripled in a year. Yeah, it feels like a bubble, and if you've ever lived through one of these, you know how ugly it can get. But here is what nobody is talking about. The AI bubble has already popped, and that means it's time to pick up the deals. I'll reveal 5 stocks to buy with discounts of 50% plus, along with important updates on cybersecurity stocks, super microcomputer, and an update to our stock market outlook. But first, on to that AI bubble, because before the war, you saw it everywhere, and after Iran, it's going to continue as investors' biggest fear. Fear that the AI bubble is going to pop and take stocks down 20 and 50%, destroying portfolios. Stocks like Nvidia and Micron technology have surged in that AI revolution, with Nvidia up 1200% in the last 5 years, and Micron, ticker MU, up 300% just in the last year. And believe me, I can relate to that fear that a bubble burst could wipe out your dreams of hammocks on sandy beaches. I started investing from the base library while in the Marine Corps in 1999, the worst possible time to start. A Marine corporal made all of $1,300 a month back then, and I sure as hell didn't want to lose it all within a year, but that's exactly what happened when that internet bubble burst. It crashed the Nasdaq Tech Index by more than 75% and wiped out $5 trillion from stock values. So yeah, the fear that AI bubble will pop is real. But Nation, what the market doesn't understand and what is about to become the biggest opportunity for investors in a generation is the AI bubble has already popped. While AI darlings like Nvidia, Broadcom, and Amazon are only down 12 to 20% from their October peak, their earnings are way up and expected to run even higher. And that means the valuation, so how expensive these AI stocks are relative to their earnings, has come way down. I'm going to prove that 5 of these top AI stocks are already at post-bubble values and show you their fair value for each. Let's start with Nvidia, ticker NVDA, down 20% from its 52-week high of $212 per share, reached late October. We know that Nvidia, with its GPU chips, is the big winner from the runaway tech spending on AI, and that spending is only going higher. Just the 4 major hyperscalers, that's Meta, Alphabet, Amazon, and Microsoft, so those 4 biggest users of AI compute power, are increasing their capex for AI to $115 billion a quarter. That's every 3 months. And total AI spending is expected over $700 billion this year alone. That has analysts constantly revising their estimates for Nvidia sales, now expected up 71% this year to $370 billion, and to post $8.29 in earnings per share. If we then look at the historic valuation ratios here on Morningstar, showing us how much investors have been willing to pay for shares on a price to sales and a price to earnings basis, we see a 5-year average of almost 24 times sales and 64 times earnings. This stock has traded on average over the last 5 years at a price of 24 times its sales and 64 times earnings reported by the company. Now, I don't want to go all math nerd on you, but just some simple math here shows how the AI bubble has already popped, and those can't ignore deals investors have right now. Towards the peak of the AI bubble last year, shares of Nvidia were trading at a price of more than 30 times its reported sales and well over 60 times its earnings per share. Right now, though, at that lower share price and the growth expected, if we take that $4.3 trillion market cap, that's the total value of all the shares in the market, divided by the current year's expected sales of $370 billion, we see the shares are now trading for a price of just 11.7 times that sales forecast. And on a PE ratio, taking the $175 share price divided by expected profits of $8.29 per share, investors can buy this stock for just 21 times earnings. Just against those long-term averages, shares of Nvidia are now trading at a 51% discount on that price-to-sales ratio and a 67% discount to the average price-to-earnings measure. Now, I don't know about you, but a 67% discount on the long-term valuation measure for a company growing its profits by 73% a year does not sound like bubble territory to me. And in fact, we can apply those average measures to this year's forecasted sales and earnings to estimate a fair value for the stock. On that 24 times average price to sales and a $370 billion in revenue gives us a market cap of $8.88 trillion, or a share price of $363 each over the next year. On that price average of 64 times earnings and $8.29 in per share profits, we get a share price of $530 each, a 200% return from here. Now, I'm not going to promise that Nvidia gets up to that $530 each, or even the $363 per share over the next year, but you can see just by taking a basic look at this expected growth and the historic valuation measures, this stock should be much higher. Now, I'm going to show you those other stock deals next, but as we'll discuss in the market outlook later, the near term is pretty rough, and these stocks could continue to sell off over the next month or two. That means you want a strategy that's going to reduce your downside risk while keeping that upside intact, and the long straddle option could be the best for it. This is where you buy both a call option and a put option, effectively making money whether the stock price goes up or down. For example, you can buy the $180 strike options on Nvidia expiring in January 2027, paying $28 for the call options and $25 for the put options. This gives you the right to both buy and sell the stock for a set price of $180 over the next 9 months. If shares fall from the current price, you start making money on those put options. If they rise, you make money on the call options. Now, no option strategy is without risk. Here, the risk is that those shares of Nvidia just don't rise or fall much, and you lose money paying for both options. I like the strategy here, though, because with that near-term outlook very weak, but the longer-term strong on that value discount, I can set this up and potentially make money on those put options first over the next few months. At that time, I'm going to sell those put options at a profit, use it to buy more of the call options for that eventual rebound in the stock. Now, that means you could potentially make money on both sides of this strategy, down and then up. And I know for a lot of you, all that options jargon is like a second language, but Nation, these are your best tools for not only increasing return, but also reducing the downside risk and creating income. To help you get started, I'm extending the discount on our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through all 29 option strategies, when to use each, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right strategy, and an options calculator to show you exactly what to expect. And right now, I'm extending that relaunch of the course at a 38% discount. Save $150 off, but only for the next 3 days. You're going to get all the basics to get you started, the strategy finder to make sure you're using the best tool, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. Now, that $150 launch discount is only available with the coupon code in the link I'll leave in the description, so check that out or just scan the QR code here. Another stock we've been following here, AppLovin, ticker APP, down 48% from its peak as investors rush to the exit on worries AI is going to replace software providers. There might be some long-term risk in that, but it's not happening overnight, and the company is still expected to post 46% revenue growth this year to $8 billion in sales and $15.29 in per-share earnings. At a market cap of $130 billion, the shares trade for just 16 times this year's expected sales, which is still above that 5-year average, but a 63% discount to where this stock was trading at just last year. Over the last 4 years, shares have traded on average at a price of 90 times its earnings. Now it's trading at just 25 times this year's forecasted profits. Even back to 50 times on a PE basis would see this stock double from here. Zscaler, ticker ZS, has been one of the hardest hit cybersecurity stocks, down 59% from its peak at $337 per share, again on fears that AI is also going to hit those cybersecurity vendors. Now, I'm going to show you in the stocks I'm watching this week next why the opposite is true, why AI is boosting cybersecurity revenue. But you can see it here in analyst forecasts, with Zscaler expected to grow revenue by 24% to $3.3 billion, and then to post $4 in earnings per share. At a market cap of $22 billion, that means the shares now trade for just 6.75 times on a price-to-sales basis, a 60% discount to the average 5-year valuation. Back up to even 12 times sales would take Zscaler up 78% to $246 per share. And Oracle, ticker ORCL, has been the poster child for this bubble burst, at one point surging 40% in a single day to $345 per share last year, only to give it all back, now down 58% and basically flat for the year. Investors are worried the company won't be able to fund its giant cloud computing build-out, and that the revenue promised from OpenAI and other AI users isn't going to be there. But folks, if you look at this and you see how ridiculous the market is right now, somehow we're supposed to believe that simultaneously that AI is so amazing, it's going to replace software, jobs, and pretty much everything else, but also at the same time that we aren't going to find the money to spend to meet that AI demand. Now, both of these fears cannot be right. And while I don't think AI is going to replace software anytime soon, it is doing some amazing things, and that money is going to be there for the build-out. That means Oracle meets its $67 billion in revenue estimate for this year and the $7.45 in per-share earnings. Applying that $67 billion in sales to the 5-year average valuation of 6.5 times gives us a $435 billion market cap, which is only 3% higher from here, but we're then looking at 30% revenue growth next year, so taking the stock even higher after that. Even better though, the $7.45 in forecasted earnings times the average PE ratio of 30 times gives us a fair value of $229 per share, or 56% higher. And again, that's before growth really ramps up next year. And here, one of my favorite AI stocks, Broadcom, ticker AVGO, hasn't fallen as much, with shares down just 24% from that peak, a testament to its strength in the industry. But here, importantly, growth has continued, which is still making these shares much cheaper. Sales are forecasted up 64% higher this year to almost $105 billion as the company levers its accelerator chips and networking. Earnings are actually forecast to fall slightly to $11.32 per share as the company spends heavily on R&D and other expenses, but then to jump 57% next year. Like Oracle, the 5-year average price-to-sales measure doesn't give us much here, only a $1.1 trillion company and $250 per share fair value. But that average valuation is a discount of 57% to what investors were paying for this stock just last year. Here, on a more realistic 20 times price-to-sales valuation against that $105 billion in revenue, we get a $2.1 trillion market cap, or a fair value of about $443 per share, and 41% upside from here. Now looking at the stocks I'm watching this week, cybersecurity stocks jumped last week as the market finally clues into the opportunity from AI rather than the risk to these companies. Shares of industry leader CrowdStrike Holdings, ticker CRWD, were up only 1.6%, but the other leaders here were up much more, with Zscaler there, ZS, and Palo Alto Networks PANW up 4%, along with Fortinet, FTNT up 6%, and Okta, OKTA, up 7% on that week. These stocks initially sold off on a leaked paper from Anthropic about a new AI model powerful enough that it could become a significant cybersecurity risk and a tool for hackers. Once that knee-jerk reaction passed, though, investors started to see AI for what I've been saying since the sell-off started in November. It's a massive opportunity for cybersec companies. Most of these are down double digits since last year's highs, with Zscaler crashing more than 50% on the idea that businesses are going to rush to replace their cybersecurity vendors with artificial intelligence. Now, though, the market is finally realizing how ridiculous that is, that a company would entrust one of its most critical functions, its network and data security, to an AI model that not only hallucinates often, but could become one of hackers' best tools for entry. In a recent survey of 100 large companies, 77% are now using AI agents, but only 4% of those have secured them, leaving a potential giant gap in their security. Now, I own all 5 stocks here: CrowdStrike, Zscaler, Palo Alto Networks, Fortinet, and Okta, and am actively buying more of some of these hardest hit over the next few months. Micron Technology, ticker MU, plunged another 10% to start the week, but then rallied 14% to close the week basically flat from where it began. The memory chip maker is still down 22% from its mid-March earnings report that, while reporting almost 300% increase in sales and beating earnings expectations by 33%, just couldn't impress investors after the stock had zoomed 700% over the last year. Shares faced further weakness after Alphabet released research for its TurboQuant compression tool that could reduce the amount of memory required to run AI models by as much as 6 times. I love this pullback and I'm adding the shares here. Investors should put that Alphabet's TurboQuant in perspective as just research that it's going to take time to actually implement, even if it can match those expectations. In the meantime, Micron is still expected to see revenue almost triple again this year to $108 billion, for earnings to boom 600% to almost $58 per share. And that puts the stock in attractive valuation territory at just under 4 times sales, about 6 times on a price-to-earnings basis, both well below the historical valuation ratios. Folks, memory chip production is still the major bottleneck in the AI build-out theme, with Micron contracting its full production out years in advance. Super Microcomputer, ticker SMCI, was up 5.6% last week and is now up 19% from its March 20th low. And folks, with more than 500 million shares traded just over the 5 days following that crash, I think the sellers are exhausted here. There is a buyer and seller for every transaction, yes, but the upward strength in this stock tells me that everyone that wanted to sell after that crash has already done so, and new sellers are more reluctant unless they get those higher prices. Now, I updated my position on the shares 2 weeks ago, which I'm going to link to in the description below, so check that out, and the valuation story hasn't changed here. Yes, management is piss poor here and continues to shoot itself in the foot and needs more independent directors on the board to unscrew this whole mess, but none of that changes the fact that SMCI makes the best AI-enabled servers in an industry of one of the biggest beneficiaries for that $700 billion in AI spending this year. SMCI is still expected to post 88% sales growth this year and earnings growth to $2.25 per share. Analysts haven't downgraded their expectations for those sales or earnings number, and we've heard nothing from buyers or suppliers, particularly Nvidia, about reluctance in doing business with this company. At a valuation of just 0.5 times sales and less than 10 times expected earnings, a discount even lower than when the company was at risk of being delisted, this stock will reward patient investors. Now updating our stock market outlook, the surprisingly great jobs number last week wasn't all good for stocks. The US added 178,000 jobs in March, a bounce from losing 133,000 jobs in February and way above expectations for 59,000 jobs added. On top of that, the unemployment rate sank back down to 4.3% as the labor force and participation rate decreased. And while that shores up fears of a weakening jobs market and economy, it isn't all rainbows and unicorns because remember, when deciding whether to cut interest rates, the Fed balances the jobs market with inflation. Weaker jobs leads the Fed to cut rates to boost the economy, while higher inflation means they want to raise rates to slow down those price increases. So with those jobs worries out of the way, the Fed is firmly focused on bringing inflation back down to its 2% target, and we're not even close to that right now. We're going to see the Fed's preferred measure of inflation, the PCE report, on Thursday, but it's going to be a delayed report because of that shutdown at February inflation, so probably won't really be any news. More important is going to be the Consumer Price Index, the CPI report of inflation for March, that drops here on Friday, and it could be fugly. Economists are forecasting prices increased at a full percent for the month, more than 3 times the inflation rate we saw in February, and a 3.3% pace over the last year. It is going to be a brutal reminder of how high gas prices have increased, and even though the core CPI, so the inflation rate minus more volatile items like gas and groceries, only expected up 2.7% over the year, that still puts inflation way above the Fed's target. Now, that persistently high inflation has taken further market-supporting rate cuts off the table. The CME FedWatch rate tool, which uses future prices to show market expectations for those interest rate cuts, now forecasts that the Fed will stay on hold until October 2027. Worse still is last Friday's good jobs report and this Friday's inflation report going to be driving odds higher of a rate increase. And nation, you don't have to look far to remember what happens to stocks when the Fed raises rates. The S&P 500 fell more than 20%, and the tech-heavy Nasdaq plunged 30% during that 2022 Fed hike cycle. So here, we're likely to see some weakness in stocks on these rate hike fears, but like so many times over the past 3 years, it is going to be a buying opportunity. Not only are corporate earnings the most basic value driver for stocks, forecast to boom 18% this year, but frankly, there's no way in hell the Fed is going to be raising rates. Chair Powell's term as Fed chair expires in May, and despite challenges, President Trump's nominee will be approved by then. Warsh has come out for rate hikes in the past, but do you really think Trump would have nominated him without a sit-down on what he wants? The president's most recent nominee to the Fed, Stephen Barron, has been a very vocal supporter of cutting rates, to the point of dissenting with the rest of the board, and the president himself has said that the next chair will lower rates. Now, the president can't control interest rates. He can't make the Fed cut, but do you really think, given the DOJ's investigation into Powell, into Fed Governor Cook, and the almost daily browbeating Powell has taken for not cutting rates, is there any doubt that Warsh is going to do everything in his power as Fed chair to avoid rate hikes and actually push for more cuts? That means lower interest rates or just the fears of the rate hike coming off the table, plus economic stimulus from tax cuts, plus very strong corporate earnings growth, all means this bull market is not done charging. We've seen a 10% correction on Iran and AI fears, but stocks are ready for the rebound and investors need to hold on. Get your $150 discount and get started investing in options with the link in the description below. Everything you need to increase your returns and reduce risk, all with a 14-day guarantee. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.